So a lot of people, when we look at the VIX, don't really understand what backwardation, what contango is. These are just fancy words that some people say sometimes, and they don't really know what it means. So I'm here to explain what backwardation is, what contango means, and what any of these fancy words that sound like mumbo jumbo from a foreign language actually mean and how it could apply to your trading. So first, let's take a second to understand what the VIX is. And what I define as the VIX, or how the VIX gets its value, is the spread between SPX contracts over a period of time. All the SPX contracts are spread, how far the bid and the ask are from each other, give you a gauge on volatility. So it kind of gives you an idea of how nervous or scared the market is when those spreads are wider. So when the VIX goes up, there's a bigger price disagreement. People aren't understanding where the market should go. And when the VIX is lower, there's a smaller price disagreement, meaning there's the market's more in agreement of what is going on. So when the VIX comes down, the spread's tighter. So it's more sure whether the market's going up or down at that point in time. So when we're looking at the VIX, we have to understand that there's not only the VIX, so spot VIX, but there's also VIX futures. So markets, specifically the CBOE, give you the ability to trade, if you like, the VIX or spot VIX, so the volatility right now, and also volatility contracts into the future. This is important to understand what backwardation and what contango actually mean. So traditionally, when the market is in contango, it means that over time, volatility is to come down, right? So essentially, as you go further out in time, volatility contracts go up because volatility short-term should continue to go down, and the uncertainty in the near or in the far-out future is a little unknown, right? Which makes logical sense when you think about it. So to put it simple numbers on it, a VIX of 1 today, and maybe the contracts for August are a VIX 5, right? And again, I'm just using simple numbers here. That makes sense because near term, the market's not anticipating crazy wild things, so the volatility is lower than what may happen in August. Between now it's October. So who knows what happens between now and August. So the market is pricing in something could happen between now and August, which makes logical sense. That's contango. Backwardation is the inverse of that. Backwardation is where the VIX, and again, using simple numbers, the VIX may be 5 right now, but in August it may be a 1. Now, what makes that weird is it's unusual because backwardation is the opposite, which is showing that near-term volatility may be higher for some reason. There's a lot of driven fear right now, much, much higher than it is in the future, which means the market's pricing in some level of extreme fear, essentially, or something very bad that could happen in the market. There's a bigger, again, we go back to what we define as the VIX, a bigger price disagreement between both sides, the bid and the ask across all XPX options chains, that the market's going, we don't know what's going to happen here short term, and that spread is actually wider than the spread over in August, those contracts. So that is giving the inkling, or gives us the idea, essentially, that traders short term are very nervous. There might be a crash, or a fear of a crash, geopolitical risk, earnings, like big earnings potentially. There's things that could affect that kind of thought process. However, it also gives the inkling that things may calm down later. Again, volatility is super high right now, but in the future, it's not continuing to remain high. So volatility is not necessarily sticky in that term. So to kind of put a button on that real quick, if we're looking just at contango, that's saying that there's calm right now and there could be more volatility later, which is typically how the market is. Right now, you're not expecting anything wild to happen, but in the future, something could happen, which makes sense. When you buy any options contract, when you buy more time, it costs more money because you don't know what's going to happen. So there's a higher risk of wild swings in price, right? Anything could happen. The more time is left on that contract. Backwardation is the inverse when they're saying there's a lot of fear right now, but the calm is expected later on, which again, the backwardation piece of the VIX is something that isn't common. It's not as common. Most of the time, the market is in contango. So now that we understand what contango is and what backwardation is, we're going to kind of dig into the understanding again of what the market may look at or do when it is in backwardation. So when the market is in, or when the VIX, I should say, is in backwardation, that's showing that there's short-term fear or panic. So something has essentially spooked the market, right? There could be a sharp sell-off, like we saw 2 Fridays ago. There could be bad economic data, again, a geopolitical risk. And what it's essentially saying is that traders on the market want insurance right now. They're willing to pay a premium to protect their portfolios right now because they're anticipating more uncertainty, higher than usual, on the market, at least in the near term, because the market cannot agree on where the SPX is. Remember what the VIX is? Again, how wide those spreads are. The spreads are either getting wider or staying wide, so there's higher fear, there's higher uncertainty, and as a result, people are willing to hedge their portfolios and pay a little bit more for that potential uncertainty to protect themselves, and that's why the VIX would be more, theoretically, more expensive. Traders are also going to expect those conditions to calm down later. So typically when we see the market move into backwardation, the VIX will spike up. And those spikes tend to be very dramatic. They tend to be very quick to the upside, and they tend to kind of melt slowly down. Now, our scenarios where the market can pop up on the VIX and it kind of shuffles in between momentarily a period of backwardation and contango where it's not one way or the other just yet, and the market's still trying to find its footing, which is ironically where we're at basically today. So we're going to talk about that in a little bit with real-time example here. But essentially, going from that backwardation to back to contango tends to, historically speaking, hint towards a market bottom, especially if that backwardation lasts multiple days. So a good example here, if we look at the VIX, we could pop all the way back to, and again, we're talking about the specific pop that we just had here recently, but let's go back to April when we had that tariff scare, or the original tariff scares here, which I should really zoom out a bit. Big pop up, right? We went into backwardation because volatility near term went really high, right? Really, really high. And volatility in the future was lower because the market was expecting things to calm off eventually, right? And, it did, right? See it happen here. But this time, so look at 4/7/2025 on the VIX, and a period of backwardation was multiple days. Tends to be, and I don't know, we can go back in time and find out, but I'm assuming we moved into backwardation probably on this candle on 4/4, maybe 4/3, and we could probably logically justify it went to 4/11. So for simplicity's sake, let's assume that we went into backwardation on 4/3, and we'll give it another day buffer. So between 4/3 and 4/14. Now let's look at the SPY and go to 4/4 and 4/13, which is down here. And 4/3 is this candle right here. So it's after we've already fallen a little bit. So volatility already kind of peaked up a little bit. And in that time period, so we go to 4/13 or 4/14, which is right here, we had some level of a market bottom. Now, again, I don't have the exact data to tell us where backwardation flipped back to contango exactly, but you see an exhaustion here, a big spike to the downside while volatility shot through the roof. And when we had 1 or 2 or 3 days of that, that's typically when that flips back to contango, the market does this, right back to the upside. All the fear is gone. We flipped greatly to the downside with that fear, and now the market resumes back to its bullish nature, theoretically, right? Go back to the 1 minute here if you guys want to watch this live. There we go. So that's something we need to keep in mind when we're looking specifically at backwardation and how it affects the market, right? Typically, when we see backwardation, it can suggest short term that the market is seeing some level of a bottom. Now, it depends on how deep that backwardation is, right? Like we just saw, or that example I just gave you from April, was a pretty giant spike. And again, I don't have the data in front of me for back then for what the contracts traded at, but we can assume that we were in backwardation for a period of days, and that allowed it to really get a rally to the upside. Typically, when we see a quick burst of backwardation, which so far we're shuffling there, so we're going to talk about that in a minute with a real-time example. When we see a short burst, so we see volatility pop to the upside here, like we just saw on the VIX right here up to 28.99, and we saw a little rally here, so we could call this a short burst. That's like a temporary fear thing. That is the market saying we're quickly panicking, right? Things could go to hell. If we see sustained backwardation, so we're staying at an elevated area where the short-term VIX is higher and the longer-term contracts are lower, that could actually be very indicative of longer-term market stress. And those are the conditions you really want to be careful of if we see that happen. So if we see a state of sustained backwardation, that could actually signify that the market not necessarily will be moving in a bear market, but that there are a lot of stressors in the market, which typically results in a bear market, but it typically would affect price very, very, very heavily. What you want to look for is if the market is in backwardation and price stabilizes, which you could argue that we've seen that on the SPY the last few days, that is the sign of that potential bottom forming. What you don't want to see is price destabilize while we're still hovering around in backwardation. So now we've gone all over that. I want to pull up. Actually, let's go over one thing. So the last thing I want to touch on before we use that real life example is what happens to the VIX if backwardation flips back to Contango and then the market still sells off. So that would indicate to us that volatility short term was high, it went back low, and then logically you're thinking, well, if the VIX goes down, the market should go up because volatility is lower, people are more sure of where the market should go, it should go up. That may not necessarily be true, and this is why I always say volatility in the market do not have a one-to-one relationship. They have a close relationship where typically if VIX goes down, the market goes up and vice versa, but that's not always the case. So what it could mean if we went from backwardation back to Contango was that there's essentially a false calm or complacency in the market where traders may think volatility is over, so they stop paying upfront for that protection, right? So spot VIX moves down a bit because near term they're not as concerned, but then the market can surprise them with another leg down, something bad happens, right? So that fear could leave the market. So let's pretend right now that the fear leaves the market. As you're seeing, the VIX is at 1935 and the other day was at 2988. And let's pretend that Trump goes into a microphone, pulls down his pants and farts directly in the microphone, and that causes the fear to flush into the market, right? The market dies off. That's going to surprise traders very quickly because the VIX was not prepared. Traders were not prepared for that. So they thought the volatility was over and it actually wasn't. So that can happen through strong earnings disappointments on like important stocks like Nvidia or Google, Microsoft, etc. Or it can happen when traders are just caught off guard, simply put, when something happens that is just kind of unpredictable. Now, if that happens, that could actually be a sign that sustained selling off will occur. So if the market sells off again after Contango returns, it suggests that the backwardation was not the bottom, it was just a pause, which is where we are right now, which is an interesting point that I want to bring up and how we're sitting actually basically between a backwardation and a Contango point in the market, where we could actually be at the start of a pull down, at least near term, as we're talking about this right now, where you're not out of the woods either which way. Things are not bullish and they're not bearish yet, but either way you're looking at it, the risk should be a risk off environment right now. Now, in general, like I said, traders may be caught off guard by a volatile event when we flip back to Contango because they think whatever the fear was in the market, in this case, in current time, it's 10/20, 2025. We're talking about trade deals with China, and that caused some fear to come into the market. And now we're talking about those deals, the fear from those deals easing, right? So consequently, the VIX is coming back down because traders are assuming that the market's going to relax at this point. Now, if that changes and the news flips again and says, nope, we're in a full trade war with China, that is actually going to indicate that the market should have a sustained sell-off, just looking at the VIX from how it's sitting right now, because we went from backwardation back to Contango. And that would indicate, if we go back to backwardation, that previous low was not the low in the market, and the I guess you can call it the fear cycle is not done yet. And you should see another spike in volatility. You may think the storm is over, but it's not, right? So now we're going to look at a real life example here where we're going to look at the CBOE, their website right now, and look directly at the VIX contracts. So we look at the near-term VIX contracts right here. And you can see their expiration right here. And we'll look at the next few weeks. And that's typically what I look at when I'm looking at volatility. And the settlement tends to be the same regardless if we're looking at between like now and like short-term December. Settlement prices tend to be similar. They're very little differences, but they tend to be the same. So right now, if we're looking at the most recent VIX contract, which is this one that expires in 2 days, the settlement price right now is at $20.91. So right now, and then let's go out to, I don't know, what is this? March, right? You have a settlement price of $21.80. So what that is indicating is that right now we're in Contango, because settlement price right now, and I'm using settlement prices to keep things easy. The settlement price is $20.91, and the settlement price of the same, or not the same, but the VIX in March is higher. So that indicates lower volatility now, higher volatility later. That's Contango. So things are normal. The fear in the market should increase over time because it is more uncertain what may happen longer term, right? However, these data points, and this is where my fear comes in and why we're not out of the woods yet, these points are very close together. We go to the furthest contract out. We can actually look at the last 4 contracts out here. 2180, 21.9, 21.9, 21.9. And right now, 2091. That's too close for comfort for me, where just 1 point on the VIX for this far out makes me a little cautious, because this tells me that near-term volatility is still relatively high. Now, I'm not saying it needs to be 30 points high or anything ridiculous, but because this is so high and because this is still in earshot, really, this could flip us back to backwardation, where this number, maybe in the next 2 days, whatever, settles at 25. And now this number is still 21.9. Guess what? We're in backwardation then. And that is telling me, if we see this is your trigger here. If we see the settlement price on our near-term VIX contracts go higher than our settlement price on our longer-term VIX contracts, that low that we saw in the market 2 Fridays ago may not really be the low. That backwardation low that we saw may not actually be the low in the stock market, and may not actually be the low for the VIX as well. This is too close for comfort for me. And this is why I took all the time to walk you through what backwardation and contango means, because now you can use this as a real life example, and you can do this again whenever you decide to rewatch this, because I'm recording it right now. Whenever you decide to rewatch this and get an idea of how to feel out and how to read the volatility, how to read the VIX right now and compare it to market performance, when you see the points this close, at least in my opinion, especially when we're looking out, like, all these months are not very far off. They should be sloped a little bit more, at least in my opinion. You may differ in opinion, but this is not a wide enough spread over all of these VIX contracts where I feel comfortable, right? And you could even argue like a short-term backwardation right here, right? Looking at 11.9, so next month's contracts versus this week's contracts, and, relatively all the other ones are the same. Where you actually have higher volume than the ones expiring this week, but the settlement price on the ones expiring this week are higher. So short-term speaking, we are in backwardation. Now, I personally like to compare longer term out because it makes more sense, but this could still drive the thought process that backwardation still persists in the market. So as a whole, this is what you want to keep an eye on when trading volatility and when looking at what the market is doing in general, to get an idea of how the SPY and SPX as a whole can perform and how other stocks will perform. And most importantly, as I say many, many times, you should not look at the market as a bear or a bull market. You should look at things as more risk on or risk off. When you're in backwardation, you should be considering a risk off position, because things are going to be more challenging. There are more emotions. People are panicking. People don't know what they're doing, right? Algorithms may wildly buy and sell. Stop losses may be triggered left and right. As a whole, you want to be very, very careful when the market's in backwardation. That's why I said, and I stress this, especially for newer traders, when you see volatility sitting the way it is, you want to wait for clearer skies. You want to wait until there's more certainty. And when there's more certainty, then you can feel more comfortable to trade safely than in an environment where volatility is a little bit more questionable.